Right now, we have obviously a war happening over in the Middle East, and there's a lot of talk around can we afford it? What's the Fed going to do? And this pressure on the Fed seems to be building, building, building. You've talked about the dilemma that the Federal Reserve has found themselves into, sort of like a chess match, saying that when you're playing chess and your opponent creates one weakness, you can defend it, but when they create a second weakness, you can't defend both, which leads to a checkmate. How many weaknesses can the Fed continue to paper over and defend at this point?
Yeah, it's a great question. I mean, I think the crazy thing is we just had a non-farm payroll print this past week, and it came in negative 92,000, and the year over year change is almost negative. It's really close to being negative. And so under most circumstances, I think it would be reasonable for the Fed to be cutting right now,
Right.
you know, um, given how weak the labor market is. But they're not, right? They're not cutting. And if you look at expectations of what they're going to do, I don't think they're projected to cut until later this year, probably after Powell is no longer chair of the Federal Reserve. So I think right now expectations of the next rate cut are not until say like September. Um, so I think the problem for the Fed right now, and I can actually show you kind of where we are. Like if you look at this chart, this is the year over year change in total non-farm payroll for the establishment survey. And when it goes negative, it's not a good thing for the Federal Reserve. And it kind of means they're behind the curve.
Yeah.
And you can see that we are really close to going negative, right? I mean, all the excess that was there back in 2022 and 2023 and 2024, when we had millions, still increasing jobs by millions per year, now it's down to 156,000 over the last year. So you could argue the labor market excess is gone. And so the Fed has a dual mandate, right? They want maximum
Yep.
employment, but they also need price stability. And a lot of times, oil, it can negatively impact CPI. It's not always a durable impact. You could argue that oil, if it takes the wind out of the sails for the stock market, might actually lead to more disinflation eventually. But the initial reaction, I think, by the Fed when you see energy prices to soar is to perhaps hold off on cutting rates. So when inflation is high, you raise rates. When the unemployment rate is going up, you lower rates. What do you do if both are going up or you're fearful that both are going up? And that's what ultimately leads to checkmate. And that's how markets go into this sort of panic mode in a late business cycle environment.
Now, what you're talking about is like the bigger, deeper picture that's been going on for a long period of time. The labor market, so to speak. A lot of people might say, and we can definitely talk about this. Maybe a lot of the weakness in the job market isn't so much. A lot of people want to blame it on AI. It's more really coming sort of as this hangover from this COVID boom that we had that didn't sustain. And so that's why I said sort of long term. It's been happening. But as of right now, there's also this war happening over with the U.S. and Iran, and we have oil markets that are starting to move pretty quickly. Obviously, that war has to be funded. How do you look at like the longer term picture and then think about the shorter term picture at the same time?
You mean like the shorter term picture in
Well,
terms
like
of the
if oil,
Fed, like what
if the straits stay closed and oil jumps to 120 or 150 a barrel and
right?
gas prices jump, then what does that mean to the Fed?
Yeah, I mean, we are in a late business cycle environment as far as I'm concerned, and there's only one way out of it, and it's the it's the word no one wants to talk about, right? It's the recession word. Um, I this is the issue that markets have, and if you look at here's a chart that kind of shows you the business cycles. So there's two ways you can look at this. This chart is created by taking the S&P 500, dividing it by the unemployment rate squared, multiplying it by inflation rate year over year, multiplying it by interest rates, and then normalizing by the money supply. And when you look at this chart, it really does show you each business cycle very vividly through the
Hmm.
decades. And you can see that we've been in a late business cycle environment here for a while. The problem is the only way this chart historically returns back down to the lows is through a contraction, right? Through a contraction in the United States. And so in the short term, how you deal with it is you say, well, yeah, I don't know if you're going to get one right away. What I could see happening in the short term is I could see things getting a little scary, but maybe we get a new Fed chair come in. Perhaps they're a little bit more dovish. Perhaps they turn the money printers back on. Maybe they use war to justify it. That might delay things. That could kick the can down the road another year. But ultimately, the way that the economy sort of corrects itself and we go back to normal times where inflation and the unemployment rate rising are not just the only issues, is through a contraction. And we're not there yet, right? Layoffs remain really, really low. We haven't really seen layoffs pick up that much, even compared to pre-COVID times. So I don't really, at this point, we have not entered into that negative feedback loop. And the negative feedback loop is characterized by companies laying workers off. Those workers then lead to less demand in the overall economy, which then leads to those companies selling less products, which then leads to lower stock prices, which then leads to more layoffs. So we're not in that negative feedback loop right now, right? And we haven't been in that negative feedback loop. But anytime the stock market starts to go down, we run the risk of entering into that negative feedback loop. And the problem for the Fed in the short term is exactly what you said, right? It's the fact that oil is starting to really go up. And the problem is when you look at the prior business cycles of the past, what caused them to end historically was a rapid rise in the price of oil. So now you're looking at the business cycle in the late 80s, early 90s, and this blue line is the price of oil. So you can see that it was when the price of oil started to go up, that's what led into the end of that business cycle. And a lot of times you'll see that play out where it's sort of oil rising in a late business cycle environment that then ultimately leads to checkmate. But again, it's a long process, right? It can take months to play out. You should not expect it to play out overnight, but it is a process, I think, that will play out.
Yeah. So not only do you have that, existing catalyst right now, the current catalyst, which is oil prices rising, to your point, you have the the jobs reports coming down, and then you add in the tech side of things, which is AI, which is then also a lot of people are expecting a lot of jobs to be sort of lost because of that. And so now you're sort of bringing in multiple factors that are all sort of converging around this like core thesis that you have.
Right. And I think it'll probably take, it'll probably take another couple of years for the whole cycle to ultimately play out, if that makes like I don't think it's all going to be over within like the next five months or anything like that. I think it could take a while because the processes take a while to play out. If you look at the last several contractions, I mean, once it was underway, it would still take like a year for it to ultimately play out. And you could argue that we haven't even necessarily entered the contraction even as of March of 2026.
Hey, if you like this short conversation I just had, you're going to love the full length conversation. Don't miss it. You can go ahead and click right over here, and I'll see you over there.